Howdy, Team 42. It's your skipper here, Darius Dale, to present our Around the Horn weekly for July 24th, 2021. Obviously, some crazy market action this week, so let's all try to figure it out together where these markets are headed. Starting with our key takeaways on slide 3. Number one, deflation ended the week with a tenuous hold on the dominant market regime distinction, with 20 confirming asset market VAMS contributing to its 38% share of the total. Several key asset market VAMs appear poised to flip back in the direction of Goldilocks next week, however. That'd be the VIX, that'd be high yield OAS. The Russell Volatility Index is even below its signal line, which would actually catalyze a recovery to neutral for both the Russell 2000 and MSCI EM index. So there's a lot of pin action right now and a lot of very important signal lines held on Monday in terms of the drawdown that we saw at the beginning of the week. So I don't know that we're out of the woods yet, but I certainly believe Goldilocks has done enough to sort of defend itself and kind of get up off the mat in terms of rendering this deflation move as a cup of coffee, as a head fake. But again, we're not quite out of the woods. So number two, does this mean Team 42 should front run what appears to be a developing dominant market regime phase transition back to Goldilocks next week? No, I kind of wrote about this on Friday's leadoff morning note, but as evidenced by the tape on Thursday, where low beta outperformed high beta by 100 basis points. And then again on Friday, low beta outperformed high beta by 70 basis points. Both times high beta was down. We are not out of the deflation woods yet. The market is still clearly sending a risk off signal underneath the hood, even though, the price action in the broader indices, the stuff that we're actually long in the portfolio construction, is making new higher highs and looking quite bullish. Number three, investors should also take notice of the fact that since last Friday, the previous Friday, I believe July 16th, small caps, IWM, small cap value, IWN, high beta, SPHB, materials, energy, and financials have all broken down to bearish VAMs. So those states, we closed the week in those states. So that's something to keep in mind in the context of the market, obviously making all-time highs in terms of the S&P and the NASDAQ. We would be remiss, number four, we'd be remiss to dismiss these signals as head fakes ex ante due to the deepening implied volatility discounts now. We're talking about discounts. Remember, we spent the past month talking about all the premium that was in asset markets. Now we're talking about discounts that have emerged in cyclicals and commodities. Could this be the beginning of the process whereby investor consensus removes its hedges that creates scope for bigger declines? Yeah, of course. Absolutely. That's implied by the setup. Is this the beginning of that process? I'm not sure, though. I would argue yes, number 5. I would argue yes, if deflation holds on to this dominant market regime, this dominant market regime distinction. I would also obviously argue no if we switch back to Goldilocks. So it's super important in terms of the dominant market regime, because those macro markets are going to send signals to investors in terms of what to do with their sector rotations, their style factor exposures, the credit risks that they're taking, the liquidity risks that they're taking. We're all getting markets. It's a very reflexive process, which is why we tend to anchor on asset markets and not the economy as it relates to our risk management orientation. And when I say risk management orientation, it's about what you're doing with the marginal dollar of capital. What are you doing with your marginal decision-making? Are you buying more stuff? Are you buying dips? Are you selling rips? What are you buying dips and selling rips in? That's what I mean, your risk management orientation. What decisions are you making at the margin as a function of the evolving market regime probabilities? That's all we're trying to do here. And then lastly, number 6, it's okay to not know. I don't know if we're going to stay in deflation or go into Goldilocks. I can make a very cogent case that if the Fed makes a policy error next week, deflation will likely take hold and actually become a trending market regime. I could also make the case as I've sort of did throughout the week, even though we were in deflation, that hey, a lot of these signal lines have actually held like champs on Monday, and we'll talk about why they held like Monday in a few slides. In terms of supporting Goldilocks. So again, I don't feel pressured to make a call ex ante. I don't think you need to feel pressured to make a call ex ante. I think we, as investors, we always feel like every time we open up our computer every morning, we log into our brokerage accounts, we feel like we need to do something. And I hope what we're trying to build here is giving you the conviction in the process to not do things when there's nothing to do. Like some days it's highly convicted to do stuff. Other days it's really we shouldn't be convicted. Obviously, we've gone through, if you look at the S&P chart, since, basically when we started the firm, it's been basically up and to the right. But if you look at charts of a lot of stuff underneath the surface, sectors, style factors, different pockets of the commodity market, it has clearly not been a up and to the right market for most exposures. It's obviously been a very narrow market from a breadth perspective. It's been very narrow in commodities as well, with crude oil really kind of taking the baton from pretty much everything else of late. So, will we see a broadening out of that? I would argue we probably would if we, switch back to Goldilocks. However, if we stay in this deflation market regime, it doesn't mean that the S&P and the NASDAQ have to go down. It just likely means that a lot of the stuff that we just mentioned in point 3 that are now bearish from a volatility adjusted momentum signal perspective are likely to remain bearish and actually start to make lower highs and lower lows from here. So again, don't feel pressure to make any changes. We're not making any changes to the portfolio construction this week. I'm trusting the process, and I'm grateful that you guys are giving me an opportunity to do that as well. So moving on to slide 4. Looking at the portfolio construction. So nothing since our changes on Thursday or on Tuesday. Obviously, we pivoted to full deflation, which required us to have 80% of the assets in fixed income and FX, 20% of the assets in equity and commodities. So that means we needed to sell a lot of equity and commodities. We got lucky on Tuesday when we made that pivot because we were selling into a ferocious rally. That's exactly kind of what you want to do there. That's why a lot of the signaling processes that we use, particularly in the volatility adjusted momentum signal, are smooth for that nature. They're smooth, but they're also smooth to help you sort of to avoid head fakes. Obviously, we potentially could be in one, but again, obviously, this was not a painful head fake. We saw things like mega cap growth was up 3% this week. Defense was up 1.5%. Something like OEF was up 2%. So it was a good pivot in performance terms. I don't know if it will be proved to be the best pivot in terms of if we go back to Goldilocks and see a broadening risk rally. But again, as I mentioned, and we'll talk about this in a few slides, I think the probability of that is actually fallen in the context of the implied volatility signals that we measure and map daily. So, keeping it moving here on slide 5. So I mentioned Goldilocks, getting it very well. If those signal lines that I highlighted, so it's 18.5 on the VIX, 27 on the Russell, 335 on high yield OAS, 93 on IG OAS, and 6.3 on the currency vol, on the Deutsche Bank currency volatility index, which is the CVIX. If all those levels hold, then all those signals will start to perpetuate themselves in a positive direction that would be supportive of both Goldilocks and reflation. So obviously Goldilocks would become the dominant market regime if that were the case. And actually I'll take a step back. The reason I put this slide in here, this is from a Bloomberg article this week about sort of the retail buy the dip mentality and how powerful their dip buying was on Monday and Tuesday to really perpetuate that. What I found interesting is that, what I just listed all those markets, you're talking about 4 different asset classes, but all those signal lines held in the same day. It was almost like an invisible hand came out, and like you rarely see this in a bull market. You typically see that invisible hand, when the market volatility is extremely high and the Fed has to come in and tone down markets. They're not going to tell you they do that, but we all know from reading Zero Hedge that the New York Fed gets busy when they need to. But anyway, it wasn't the Fed, it was retail. These guys bought $2.2 billion of equities alone, and most of it went into ETFs, like the actual indices. They put 482 million of that, so nearly a quarter of that, or at least a fifth of that into the spider. This is the same retail community that's been, picking Dogecoin and buying, pot stocks and buying, going as far out in the liquidity spectrum and credit risk spectrum as they possibly could, really throughout the first sort of 3 quarters of this bull market, off the March lows of last year. But, now they're saying, hey, no, we don't want to take single stock risk. We've seen the chart of Bitcoin not recover. We've seen the chart of Ethereum not recover. We've seen a lot of things that have woken them up to, hey, you can suffer drawdown speculating. So I think we're going to see, it's very likely if we go into Goldilocks, you're going to see a lot more activity in the main indices, because again, that's what the risk tolerance of this marginal buyer is suggestive of, as you see in the 4th point there. In terms of their willingness to buy single stock exposure, they bought 40% less single stocks than they did in the late June correction. So that to me is a big signal that, hey, these guys want to play ball, but they don't necessarily want to play ball the way they were playing ball when it was pure reflation, and that was a very obvious sort of trending market regime. And so what that tells you is that, hey, if these guys don't want to play ball in single stocks and reflation, then the probability that you get a broadening reflation rally is actually diminished relative to where it was let's say a week ago, a couple of weeks ago, certainly with a lot of the implied vol premium that we had in those exposures prior to the decline, but now it's all morphed to discounts, which we'll talk about in a second. But the last thing I'll conclude with at this chart is that this community of investors has 400 billion in dry powder. I mean, I'm not sure how data trade gets to that number. It's obviously an estimate, but I can tell you right now, if they bought $2.2 billion of equities on Monday, and we saw what we saw on Tuesday, I'm guessing it was more than $2.2 billion. These guys have a lot of dry powder. They probably came out of crypto. It probably came out of some of the more speculative vehicles that they were trafficking in the first half of the year. And ultimately, they're probably looking around for trying to figure out what to do with it. They're like, bonds are too up on a rope. And to some degree, they've perpetuated that with call buying and TLT and things like that. But again, this is the reason I flagged this is because then this was a big marginal participant this week. I was shocked to see all those levels basically hold. Like there's no reason for them all to hold at one time. There's no catalyst. And so when you see something like that, you got to go dig in further and try to figure out what actually happened. And this, in my opinion, is really what happened. On slide 6, the other side of the debate, the Goldilocks deflation debate, because again, I don't believe the reflation inflation debate is a legitimate possibility. We'll talk about that in a second as well. Meanwhile, the Fed has the power to perpetuate deflation. So will Powell walk back the market implied rate hike that we got from the hawkish dot plot revision last month? Or will he bend the knee to Bullard, Kaplan, and Bostic, who are all like, hey, man, this is getting out of hand. Bullard especially. I mean, Bullard sounds like he's ready to hike rates in like 2 weeks. So I think Powell's going to have to do a real sort of Jay Powell. He's going to have to do his best Jay Powell, to sort of back those guys off and really send a reassuring signal to asset markets that, hey, tapering is not really on the table until Q4. Let's get this thing going. Let's get the labor market going. Inflation's transitory. And again, we've always been in the inflation's transitory camp. We've always been in the camp that you're probably not going to see a meaningful recovery in the labor market until Q3, the end of Q3, if not the early part of Q4, when kids go back to school. And so, that's how you can get, Goldilocks really sustaining itself and a real narrow market rally into that ultimate, crescendo from a policy perspective, later in Q3 or early in Q4. But if he's got a lot of institutional pressure around that table in the equities building now that I just don't know if he is going to be willing to go out there and be as dismissive of inflation and sort of supportive for asset markets as he has been in recent FOMC meetings. So again, we got a big catalyst next Wednesday, big catalyst next Wednesday. Stay tuned for that. We're trying not to follow the Fed. We usually want to front run the Fed, but obviously, all the frameworks that we've all been conditioned to study in order to front run the Fed have all changed. We have an average inflation targeting mandate now. We have a maximum and inclusive employment mandate now, and those are both new. I don't even think the Fed understands what they mean by both of those things. So what I anticipate is that in Jackson Hole, and I believe that's on the 25th and 26th of August, in Jackson Hole, they're going to be forced to outline exactly what they mean by, what's too much inflation. They're going to be forced to outline what they mean by what is substantial further progress. And then, once they outline that, investors can really start to look at the calendar and say, this might be the month we do that. This might be the month we do that. And so that's when you can really start to see the path towards tapering crystallize, in my opinion. The risk of that, of all that happening sooner is obviously elevated because, again, every Fed meeting is a live meeting now with inflation north of 5%. It has to be, right? These guys have come out. We've been in the quiet period this past week, and we're going to be in the quiet period early next week as well. But, when that prior to the quiet period beginning, everyone but Jay Powell, in terms of the talking heads of the Fed, the guys who have the loudest sort of platforms, we're all moving in the direction of being incrementally hawkish. So this will be something that's really interesting for asset markets to figure out next week, and we'll obviously stay tuned and react to the changing market regime probabilities into and through that event. On slide 7, global macro risk matrix kind of beat this like a dead horse this week throughout the leadoff morning note in terms of all the things that are signaling and being supportive of deflation. If they flip back the other way, Goldilocks, not only will deflation lose points, but those points will be going to Goldilocks. It won't take much to flip it back in terms of, the early part of next week. But I just assume not do anything from a portfolio construction perspective until we get to the other side of the Fed meeting. Because again, if he says something incremental, either in the direction of, keeping the punch bowl full and keeping it here, or taking the punch bowl away, those will be very important signals to asset markets to digest. Because again, asset markets are very clearly directionless. We had a lot of neutral signals across a lot of these asset market VAMs in this table. You take out the bond market, which clearly it's like bearish VAMs everywhere in terms of interest rates. It's a lot of neutrality. and that neutrality is still yet to be really unresolved. And so that's something we got to deal with. You look at slide 8 here, that neutrality is expressed through the lens of what we call the total confirming asset market VAMS. The total amount of confirmation across the 4 grid regimes that's being received from that global macro risk matrix. And 53, it's still a pretty low number. Now it's in the 45th percentile of the historical time series going back to the beginning of 98. But that's not a healthy number relative to actually markets having conviction in either Goldilocks or deflation, right? When we had maximum conviction in reflation at the beginning of June, that was at 83. So obviously 53 is a materially lower number relative to that. So it's obviously up off, the lows of last week and a couple of weeks ago, but certainly still not at a level that would say there's a lot of conviction out there in terms of the direction of asset markets. And more importantly, not even the direction of asset markets, really the sector and style factor leadership within the equity and credit markets, where bond yields headed from here. Like, I think people are very confused. And I think there's some confusion I've seen on Twitter recently about, okay, if it's not deflation, why are you saying it's Goldilocks? Why not inflation? It's the second highest market regime probability, as indicated in the chart on the right here on slide 8. I think slide 9 kind of answers that question. So inflation is unequivocally a risk-off regime in our grid framework. You look at the annualized expected return for inflation, the top left chart, that's actually the lowest if you look at the entire grid regime back test, in terms of taking in all the data across the 25 years of the study. In fact, it has this is just the S&P 500. The S&P 500 has the lowest percent positive ratio in inflation. So when you slice and dice the data with monthly grid regime outcomes, you start to experience and realize different conclusions from the data. Again, these are new models. This is new. Quite frankly, I think these are some of the best models in the world in terms of regime segmentation. I know I've built a lot of them. Built some very popular ones as well. This model suggests that inflation is a risk. Not only it confirms that inflation is a risk-off regime, but the reality is if inflation was the next regime, you wouldn't necessarily be seeing sort of the positivity. I think people think that the NASDAQ up, the S&P's up, mega cap growth's up, so that must mean inflation. Historically speaking, that's actually not the case. What the market is signaling is either a very narrow deflation. If you look at minus a 0 sigma growth on deflation, that's historically been a positive 11% on an annualized basis. So I think that's what the market is either signaling. It's either saying, hey, we're going into Goldilocks, or it's not Goldilocks from an economic perspective, but it's actually just a meaningful, manageable growth slowdown, which is how you can get positivity from some of the more defensive sectors and style factors within the equity market. And oh, by the way, the S&P 500 itself, which itself has just become a giant bond proxy full of tech companies, in terms of the weightings there. So I just want to break that down because I did see a lot of questions on Twitter about that. On slide 10, obviously, deflation remains the dominant market regime. It's got a tenuous hold on that dominant market regime. The last time we had a head fake was inflation in the early part of late October, early November for a cup of coffee there. Again, we're happy to pivot back. I mean, that's the whole point of, you go back to slide 4. That's why we had 40% cash. Like, we could have just taken it and said, hey, no, let's keep filling out these fixed income and FX exposures to the point where we get up to that whole 80%, right? Like, you get to 80%, for fixed income effects as a function of the dynamic asset allocation framework that's really powering the portfolio construction process. Well, I said, no, it doesn't make a ton of sense. Let's not be too hasty, because deflation might turn out to be a head fake for all the reasons that I highlighted in the note on Tuesday. You had high vol premiums still out there. You had the dispersion signaling, but you could see a pain trade. You had earnings season, obviously, which was the catalyst this week for getting a lot of stocks off the lows on Monday. Again, a lot of those things hadn't gone away at that particular moment in time. And so we did want to reserve some cash to say, hey, if we need to, further pivot back to the Goldilocks, we want to have cash to actually do that, as opposed to having to sell things out of bonds and FX to go buy equities and commodities. So there's a method to the madness. I don't wake up at 4:30 to hop on Facebook and chat with people. It's to dig into the models, to understand the data and see how the data and the probabilities are evolving, so that I can report it to you, and so we can all try to help hopefully make some money together. On slide 11, jumping ahead, Positioning, this is again the CFTC commitment to traders crowding analysis that we look at. Nothing to call out from a portfolio construction perspective, but we do see a bearish near-term warning signal on WTI. That actually the week over week delta there is down by 56,000 contracts. That's a minus 3.1 Z-score in terms of that particular time series, the week over week delta. Historically, that's meant about a down 2% on average performance on a 3-week forward basis. So something to call out, because again, oil, one of those assets that perfectly held its signal line, went directly to the right through it. Actually went to, we had a 65 handle on WTI on Monday, and then just like clockwork, and like everything else across asset classes, tested their signal lines and bounced right off of it. So to me, that was like a very important signal. One, it's a signal that the model that I built, the volatility adjusted momentum signal model that I built, is working, because when you see asset markets do stuff like that at the signal line, clearly the signal line is important. So that's important to call out. That's good. That's reassuring that those signal lines were actually in fact signal lines. But secondarily, I think the bounce in crude oil is pretty ferocious. But again, it's got to do a lot more than that to perpetuate higher highs, as we'll talk about in a couple slides. On slide 12 here. So again, we look at crowding and we look at dispersion, the first through the lens of the relationship between implied volatility on a 30-day at the money put basis relative to the mean 30-day, relative to the mean local volatility regime, which we're sort of, amalgamating or kind of cheating by saying it's the average of 10-day realized volatility, 20-day realized volatility, 30-day realized volatility. You ever try to calculate local volatility in your computer, you're going to break it. It's a very data intensive process, but this is our kind of our cheating way to do that. Nothing especially actionable. Typically, so what is actionable when you look at this slide here? What you want to see, if you're bullish on something, is an implied volatility premium on a middling to high level of realized volatility. That almost never happens. Well, if you're bearish on something, what you want to see is an implied volatility discount on a very middling or actually on a low level of realized volatility. That happens a lot more frequently, but still doesn't happen particularly frequently at all. The reason it doesn't happen frequently at all on either pole is because volatility tends to mean revert in and around realized volatility. The options market is smart. It knows things don't go up or down in a straight line. So it starts to price in mean reversion, and that's precisely what it's doing. If you look at where the implied vol premium is, it's in stuff that hasn't really corrected. Where if you look at where the implied vol discounts are, it's in stuff that's meaningfully corrected. Again, that second number in the parentheses there next to the name and the ETF ticker, that second number is the trailing 3-month Z-score of that realized vol reading, the mean 10-day, 20-day, and 30-day realized vol reading. So, when you see something at like SPHB, that's a 2.6 Z-score. So over the last 3 month on the 3-month observation window, that mean 10-day, 20-day, and 30-day realized volatility, that latest data point represents a 2.6 standard deviation relative to that trailing 3-month window. So obviously it's had a correction, as that's implied by that, but now you're starting to see implied vol mean reverse. So again, nothing especially actionable this week. I think we saw a lot of the corrections that the market was really nervous about from an implied vol premium perspective in a lot of the cyclical sectors and style factors. And so really the question is, can they recover? And more importantly, can they really break out to the upside? I think the probability of that is much, much, much lower than it was, heading into this week, and obviously last week. And part of the reason is, we saw again a lot of breakdowns in high beta cyclicals. Materials, energy, financials all broken to bearish VAMS. Gold miners and silver miners are broken to bearish VAMS. Microcaps are broken to bearish VAMS. We're seeing, kind of underneath the surface, a little bit more pain than what's implied by the overall index. So when I look at this chart on the right here, the dispersion, which we look at through the lens of month-on-month Sharpe ratios, across 50 different U.S. equity sectors, style factors, and mega cap FANG names. And, what we're trying to do is find that, rank the performance of the upper quintile relative to the lower quintile to give you a sense of, okay, what grid regime is the market either moving towards the price in, or investors that, particularly pod shop investors who are a little bit more dynamic with their exposures, what grid regime are they being implicitly forced into by the risk management systems at the broader mothership? So, that's why we look at it this way, and just kind of looking at the chart. If you told me that all the stuff in the bottom quintile had elevated implied volatility premium still, I would say we're going to see a pain trade, because the amount of spread we're seeing, -4, -5, -3s in terms of month-on-month Sharpe ratio, that's a big difference. That's a big delta relative to the stuff at the top. like you typically don't see, there's all the take, it's usually skewed, right? Like there's a lot of stuff here, and then the stuff at the lower quintile is just not as positive or slightly negative. This stuff is deeply negative, while the stuff at the top is deeply positive. So there's definitely a risk of a pain trade in terms of how much people have really put on this sort of defensive portfolio, these crowded into defensive exposures and really crowded out of cyclical exposures, but you just don't see the fuel to perpetuate a sustained recovery. And this is why I'm really calling out those bearish VAMS signals in those cyclical sectors and style factors. To me, it's just like that's a warning sign that, hey, like what's going to get you to recover from bearish VAMS? And that to me is like the big question that we're going to go through next week, because again, retail could actually get more bullish and start to buy these things, or Jay Powell could catalyze something that looks a lot more like, kind of a rolling series of market peaks, which is exactly how asset markets have historically peaked. It's always, a rolling series of peaks. And at some point, it just catches up to the broader index. So eventually we'll get there. I just don't know if it's that, if we get there next week, or if it's something that is likely a later in Q3 or early Q4 event. So again, 40% cash for a reason. We don't know the answer to the question, but as soon as we get the signal, we're ready to go. So you guys should be ready to go as well. On slide 13, S&P 500. So that's neutral VAMS. If the VIX stays below 18.5, which obviously it's well below that, it'll break back to bullish VAMS. So that's why I call it a faux overbought signal, because we all know the upper boundary of the probable range will snap back to the upside to create some room for that bullish VAMS signal to work itself off. WTI, neutral VAMS, it's nearing overbought. OVX needs to break down below 38 for it to see higher highs, in my opinion. We're not in my opinion, and in the model's opinion, that's the signal line for the local volatility regime of the OVX. So if we stay above 38, oil's probably put in its top, and I don't hear anybody saying that. Like that to me is like that's a big deal in terms of like we're not going to inflation if oil's put in its top. So I think that's something to call out. Like inflation, you think about like the most obvious example of inflation in terms of the back test is like the first half of 2008. Oil's ripping to $145 a barrel, stocks are down, credit's down. Like that to me is a perfect example of inflation. You've got an intermittent bounce of that in 2011, obviously in 2015 with the China devaluation as well. That was inflation. So that inflation, when it comes, it bites. It's a risk-off regime. So don't be dismissive of it. Like, okay, it's only inflation. I can go buy everything and kind of just get out of the small caps and cycles. No. Inflation is it can be deadly. Just as deflation can be deadly, but deflation, because of the disinflationary forces, if growth isn't slowing that fast, it has historically perpetuated actually positive performance in risk assets. So that's a little bit different than inflation has. Inflation typically is negative no matter what. On slide 14, getting back to the signals, US dollar, that's neutral VAMS still. Again, I highlight this, the currency volatility index. If it breaks out above 6.3, we're going to have a bullish dollar on our hands, and a bullish dollar on our hands is going to be risk off for a lot of things. And maybe that's what some of these cyclical charts are starting to sniff out, is that this dollar is very close to breaking out, quantitatively speaking, which obviously would catalyze a lot of risk off across a lot of macro funds. A lot of people who anchor on the dollar as a real leading indicator for their exposures. Looking at the 10-year, that's still bearish VAMS. If you look at the lower boundary of the probable range, is the zero handle on it. I don't think we're going there in a straight line. We're definitely going to get there in the next couple of weeks, but that's something to call out. On slide 15, 10-year break even, that's bearish VAMS. Finished the week perfectly overbought. Can Jay Powell fix this chart? I highlighted, okay, that hawkish dot plot revision was effectively a rate hike to long-term inflation expectations. We took out inflation premiums from the long end of the treasury curve. Can he fix the chart with his words in terms of getting this to break out, at least back to neutral VAMS, and obviously, hopefully back to bullish VAMS? We'll see. I mean, again, there's never been a time in history where one person's words could have so much impact on global financial markets. But guess what? This is the system we've allowed to develop as the voting public, and we got to deal with it. Sticking with slide 15, high yield OAS. So it broke to bullish VAMS, but again, the last price is below the price regime signal line. So again, it's a lot. It's like one of these, all these markets. Again, I mentioned the S&P 500 because of the VIX, Russell 2000 MSCI EM index because of the RVX, high yield credit spreads, IG credit spreads, currency volatility. A lot of these things sort of tap dancing on their signal lines. This one is tap dancing on the positive side of its signal line, but IG OAS is tap dancing on the wrong side of its signal line. That one's 93 basis points wide. So again, this asset markets are at a very critical juncture even more critical. Like I probably said that like 5 weeks in the last 3 months, and this is probably this is as important as any of them because of so many things are at their signal lines that it could either say nope, we're going directly to deflation, and actually you'll get a little bit more risk off than we've realized, or it's going to say Goldilocks, and we have, again, there's really no real probable path for the Fed to incrementally tighten from here until the labor market really meaningfully recovers. Because again, if they can look a 5% CPI print and four and a half PCE print in the eye and say no, not today, then it's really just going to be about the labor market. So we'll find that out on Wednesday. At the bare minimum, we'll find it out on Jackson Hole. At the end of the day, we don't have to have a view on that. We don't know because we're not sitting in the equities building. I'm not sure if they know yet what they're going to say and how they're going to come out on this. But ultimately, the global macro risk matrix is designed to not have to know every single catalyst. If you orient your risk management according to what the global macro risk matrix is telling you the dominant market regime is, you will be better off than worse. At the bare minimum, that thing is really good at preventing drawdown risk. At the bare maximum, it's going to get you in the best sectors and style factors to outperform. But not all the time. Certainly, this was not the easiest week to risk manage, but certainly I don't think we did a bad job. As I mentioned, the equity exposures in the portfolio structure up 1.5 to 3%. The fixed income exposures were up 0.5 to 1%. It wasn't a bad week. It just just might be a head fake. But at the end of the day, that's my issue, not yours. We're all here. We're all trying to make money. On slide 16, just getting into the position review. Defensives, that's a neutral VAMS signal. I think it's perpetuating a faux overbought signal because, again, if it breaks up the bullish VAMS, then you're going to get the widening of the upper boundary of the probable range. As you know, those two processes are linked. Mega cap growth, MGK, that's bullish VAMS with an additional 2% of upside. So I would imagine if defenses broke to bullish VAMS, you're going to see at least a percent and a half of upside, relative to that the MGK signal. On slide 17, same thing with DEF. It's the neutral VAMS reading is perpetuating kind of what appears to be a faux overbought signal. Again, if we break the bullish VAMS, it's going to widen the upper boundary of the probable range. Real estate neutral VAMS not actionable. 18 healthcare bullish VAMS nearly 3% of upside to the upper boundary of its probable range. So the things that held on to their bullish VAMS signal, mega cap growth and healthcare, have 2 to 3% upside in the probable range. If those things are realized, obviously a lot of stuff is going to realize more upside in terms of the portfolio construction, and that'll likely be a function of Goldilocks obviously confirming itself as the dominant market regime again. So the setup is certainly there in terms of being potentially able to achieve that. Their setup is also obviously there because we're in deflation narrowly, very tenuously, and you have a Fed event catalyst that could actually go the wrong way, just like it went the wrong way in June. So we'll see. On slide 18, Barclays Act, that's neutral VAMS, not actionable. Slide 19, the extended duration treasuries, neutral VAMS, not actionable. EMD, the emerging market dollar debt, that's bullish VAMS, still not actionable. Gold, bullish VAMS, that's nearly oversold. So good opportunity to buy more gold to the extent you're not fully allocated there. Buy some calls if you're already allocated. Treasury belly, neutral VAMS, that's not actionable. 21, IG credit, that's neutral VAMS, not actionable. Same with 1 to 3 year treasuries, neutral VAMS, not actionable. It recently broke 2 neutral VAMS, directionally positive, obviously, in terms of the volatility adjusted momentum signal. On slide 22, looking at 5 to 10 year tips, that's bullish VAMS. That's a win-win no matter what. If we go to Goldilocks or deflation, that's kind of the point, right? Goldilocks or deflation is going to be really good for 40% of the portfolio construction. So it's obviously pretty good if you go into a narrow, like a narrow decelerating economy in terms of that from a perspective of deflation for the equities as well. So you could, it's really just a function of, okay, are we max it fully invested? No, we're not fully invested because we don't have enough signal to say we should be fully invested. Deflation has a very tenuous hold on the dominant market regime distinction, but at the same time, we're not getting a real affirmative move towards Goldilocks either. So maybe we get that next week, maybe we don't. Again, it's not about trying to guess, it's about reacting to the signals. Don't predict the predictors. This whole process is designed to be a predictor. If you start predicting the predictors, then you're just making poop up, pardon my language. Slide 22, same thing with slide 22, 10-year, 20+ year treasuries, TLT, that's neutral VAMS, not actionable. And then on slide 23, the US dollar, that's neutral VAMS, not actionable. Spend some time talking about that and the kind of signal it might send to the extent it breaks to bullish. And then again, mentioned we have cash at 40%. That will be likely be redeployed to Goldilocks based on everything I'm seeing from a local volatility regime or local price regime perspective, and some of the signals that have moved towards deflation in the past week. It looks like they want to move back towards Goldilocks. So if that's the case, that 40% cash is going to go into equities and commodities. However, if we sustain deflation, then we're likely going to stay in 40% cash or start to allocate to more fixed income and FX. But the reality is, when I actually did that portfolio construction pivot on Tuesday, there wasn't a lot of stuff to buy. Like it just wasn't a lot of stuff to buy. Like when you slice and dice currencies and fixed income through the lens of our grid asset market back test, and obviously we're looking at annualized expected returns across the regime. We're looking at percent positive ratios. That's the y-axis on those scatter plots. On the x-axis of those scatter plots, we're looking at volatility and covariance. And when you start to slice and dice it and visualize, where should I be, incrementally allocating exposure, there wasn't a lot of stuff left to buy. And so, for those of you who don't feel comfortable sitting on 40% cash and need to feel like they need to be fully invested, I think you hope Goldilocks is the outcome. Because if we stay in deflation, guess what? There's likely going to be a decent amount of cash. But at the end of the day, I'm cool with that because, again, one, I'm guessing most of you at least had a decent year to date. And so you don't feel the need to actually chase. But more importantly, this process, I say this all the time, the reason you engage with macro risk managers like myself is to prevent drawdowns. It's the number one reason. Like if your goal is not to use my talent and my intellect and my hard work and my team to help you prevent drawdowns, then what's the point? Like you can just go buy stuff. The asset markets over time go up, generally speaking. Like even bonds and stock, they both go up. Commodities, they may invert a lot, but they still generally go up. Like stuff goes up. The whole point of engaging with macro risk management is to get signals and timing on how to avoid drawdowns in your net worth, in your portfolio, in your client's money, in your money. I don't know whose money it is, but it doesn't really matter. At the end of the day, nobody likes losing money. And so when we see, a D, going back to the dominant market regime slide, I believe that was what slide was that? My apologies here, slide 10. Are there head fakes in this process? Yeah, it's a data-driven process. That's if you have a signaling process, of course, not every time you get a signal, it's persistent. However, when you get those signals, you don't know if it's going to be a skinny blue bar or fat red bar. Sometimes it's a skinny red bar, sometimes it's a skinny blue bar. But sometimes it's a fat red bar or it's a fat blue bar. And the market goes down 20, 30%. So like you can't have a process that's designed to help you lose money and ignore it when it says something that could potentially save your butt. That I understand, why I'm giving you all the reasons. Again, I don't think anybody in finance is this transparent about their process. I'm giving you the data every week when I publish it. You get the market regime data, you get the macro regime data as well, although it's less relevant in moments like these. The whole point of this is to help empower you to make good risk management decisions on your own. Like, obviously there's a contingency of you guys that are following along with the portfolio construction, and I appreciate that, but I appreciate that just as much as I appreciate the people who aren't following it on their own, because I'm giving them the tools, the data, and the consistency and transparency to actually make thoughtful decisions on their own relative to the things that they like investing in, relative to their mandate, their investment mandate, to the extent they're a professional investor. So at the end of the day, I'm grateful for this opportunity to be on Team 42 alongside you. I clearly don't have it all figured out. Like I said that in our first Around the Horn weekly video, and I'll say it in our last Around the Horn weekly video. This is a learning experience for me. It's a learning experience for you. And thank God we're in this boat together. So God bless you guys. We'll catch you back here next week. Cheers.